All right, everybody. We might as well get started. So basically today's lecture, we're going to continue on with our discussion from last lecture, which was about trying to make sense of this model that is very commonly used by VCs, so much so that it is given the name VC method. If you recall, it's a method that is very simple and user-friendly once you're willing to use rule of thumb numbers for certain key parameters in the model, right? Maybe I'll just go back a few slides and just help you guys remember what the VC method was about. As I said, there's one key input in VC method that's really difficult to get that we are not modeling yet. That's what we're going to be doing in parts 2 and 3 of this topic, right? But every other key parameter in the VC method, amount of investment that's being proposed, expected time to exit, number of shares that already exist in the company before you potentially make your investment, and this thing that was called the VC, in quotation marks, discount rate. Remember, not a real discount rate, and we'll get back to that in a second. Those were the inputs in our model, and the model itself gives us a formula or a sequence of formulas that allow us to get what is the post-money value of the company, right? What is it worth after the investment? And given that value, what percentage of the company the VC must be given in order to justify them making the investment. And if you recall, we built kind of a simple NPV model to really understand what that meant to justify the investment. And let me reemphasize, we had said, in order to justify the investment, this investment must be a good deal, not to the VC, but to the limited partners that give money to the VC. Right? And when we built that more rigorous and first principles based valuation model, which we had done in the second part of last lecture, we had eventually gotten to an equation that would reconcile the VC method with more rigorous valuation. And what it told us was that the VC, in quotation marks, discount rate was not a discount rate. It was actually something that picked up a whole bunch of information. In particular, it picked up the discount rate. That shouldn't be a surprise, right? But it also picked up expected future dilution, probability of success versus failure, and all the fees that the venture fund charges, right? And by the way, that is why the value of D is so high compared to the average expected return of a venture fund. That's the thing that made that really weird observation that we had highlighted, where rule of thumb values for D for a Series A are 60%, and yet the average rate of return for an early stage venture fund was more like 14%. The reason why those two things can be reasonably accurate is because D is not equal to R. D should be equal to all of this. Now, what do I want to do today? I want to get us to pursue the idea of this reconciliation formula. I want us to pursue that a little bit more seriously using real world data. Because here's what I'm going to try to do at first. We've got our rule of thumb values for D, right? So for a typical Series A, D is equal to 60%. And for a typical Series A, T is the rule of thumb value about 5 years historically. Well, what are other things that we could measure from historical data? we might actually be able to measure anticipated future dilution from historical data. If we can find a comprehensive data of Series A investments, and we can track those investments over time to find out when exit occurs, how much dilution thereafter had occurred, we could get a sense of what the average dilution post Series A is. Do we agree with that statement? What else? We could also try to look at historical data. If we've got that data set that follows what happens to a company after a Series A investment, well, we could also see, well, after that investment is made, what percentage of those investments eventually have a successful exit? That would give us the probability of success. Do we agree with that statement? Right? What about management fee, carry fee? Well, those we actually know. Most VCs have a management fee of about 2% and a carry fee of about 20%. Look, there are some exceptions. A really prestigious VC firm like Sequoia charges more than 20%. But it's very much the exception rather than the rule in VC. Much more so, for instance, than in the hedge fund space. You look at the hedge fund space, like there's a very famous hedge fund called Renaissance Technologies, founder Jim Simmons. They no longer take outsider money. So all their money is investing employee money. But when they used to take outsider money, their carry fee was 50%. Which is insane. They still did well by their LPs. And it's not uncommon to see a hedge fund maybe charge 25 or 30%. It is much rare to see deviations from the 220 fee structure in VC than in other forms of delegated investment management that are carry fee based. So what that means is I feel comfortable using a management fee of 2% and a carry fee of 20% when I'm thinking about this formula with real world data. But what does that mean? If I find that right database where I'm able to estimate delta and P, notice I know every parameter in this formula except for R. So then I can solve for the R of a Series A investment.
Jiro?
Yeah.
I don't mean to jump the gun here, so feel free to delay the question. But my question is, when you're trying to estimate the probability of success, how do you define that from a third-party point of view, right? Of what is a successful exit?
Yeah,
I mean, the company wasn't a flop, or?
Sure. Okay, so Mike, that's a good question, and you're not jumping the gun. Remember how I had defined success in my basic model? I said if you fail, it means it was a 0. So basically anything that exits at non-zero is a success, right? So, right, but then you're saying like, well, that's a pretty low bar. Fine, but when I define exit value conditional on success, I better, in getting that number, factor in low valued exits. So if you're saying that's a little bit weird, it just means that we need to be careful when we get this number. And when we get this number, we should factor in all exits, including puny ones. So long as we do that, then what we've done everywhere afterwards by saying failure is only when it's a big 0, it's okay.
Got it.
So actually, your question was a good one because I wasn't planning to actually even clarify that. And now that you asked the question, I realize that it's actually valuable to clarify it. Sound good?
Thank you.
No problem. So that's what we're going to be doing. Now, of course, question is, Jiro, where do you get that magical data set? Where do you get a data set that follows a large representative sample of different VC investments? Series A onwards, or Series B onwards, or Series C onwards. Where in the world do you get that? So here's a reality. There's no perfect database. Okay, that's just a fact, and we got to just live with that. But just because we don't have a perfect database doesn't mean that I'm going to just ignore all data out there. So what I did is I looked at data from a data vendor called Sandhill Econometrics. That was a data company that was based in the Bay Area. They are now owned by Dow Jones. It is one of the most extensive databases on deal investments and outcomes, full stop, in the marketplace. They also do other stuff. They're also the provider of a VC industry index of returns. I'll talk a little bit about that maybe later. But it's actually useful to note where they get their data. And actually, it's an interesting business model, actually. They get their data from limited partners that put their money in different venture funds. Why is this an interesting and clever idea? Because the LP will know all the investments. Every time a VC wants to make an investment, they make a capital call. So whenever my VC makes an investment, I know that they've made an investment right away because I had to send a check. And they send newsletters to me on a periodic basis telling me about new funding rounds, telling me about, when I say new funding rounds, I mean like when a portfolio company raised more money later on. They have to tell me when there's an exit because they got to send me my money, right? So the LP is like, if you knew every LP in the world and you were buddy-buddy with them and they would give you the data, you would know everything. So Sandhill Econometrics tried to approximate that by networking with as many LPs as possible and offering them the following proposition. They say, look, if you give us your data, we will do analytics on your data and the data of every other LP that shares data with us, and we will benchmark the performance of your VC with other VCs in that way. But we will only give you that benchmarked information if you share data with us. And then people are like, oh, you know, it might be nice to know a little something about how my VC is doing compared to other VCs. And so they share. This was a sufficiently effective way to go that this is the largest database available. I mean, like the data that I used, look, this is a very expensive database and I don't have access to it anymore because this institution is unfortunately, it's not a criticism, unfortunately not rich enough to afford it. It is what it is. The data I had was from 1980 to, I think it's 2008. That's what I was able to get access to. To be clear, in a completely legal manner. I don't have access to it anymore. It's, I vaguely remember, I'm trying to remember the actual numbers, but it was something like a database of over 60,000 investment rounds, which represented investments into almost 20,000 companies. That just, I mean, that's a huge database specifically for VC. So that's why I'm going to be presenting numbers to you guys off of this. This is actually considered cream of the crop in terms of data. And it's the one that I once had access to, but since I don't have access to it anymore, my numbers are not updated to 2020. Okay, it is what it is. If you guys become rich and want to buy the data set for this institution, by all means, please. In any case, it might take a while. That's a 2030 kind of objective. But let me tell you a little bit about what the data includes. The data includes for every investment that they get through the LP funnel, so to speak. The LP tells them what company, received the investment. They say who their VC was. They specify the initial investment and what that initial investment represents in terms of an ownership percentage. Then, once that investment is recorded, the LP periodically updates that investment's information to Sandhill Econometrics. Most notably, once an exit occurs, they tell Sandhill Econometrics whether this was an IPO, whether this was an acquisition, or whether the company goes kaput, defunct. And in addition to that, they say, well, at exit, we ended up owning this percentage of the company, and this is the amount of money we received. Right? So if your initial ownership was 20% and your final ownership was 5%, then we know you got diluted 75%. So you guys can start seeing how this data allows me to get dilution. Dilution is just comparing this number with this number. Meanwhile, we can also see how we can get probability of success. What percentage of these deals eventually become this and this as opposed to this? That is my strategy for trying to find a value of P and delta to plug into this formula so that then I have one equation, one unknown to solve for R. So look, as I said, I use Sandhill Econometrics. There are other databases out there. You've got kind of, okay, I say free-ish, but actually tells you something about free databases. Crunchbase is no longer free. So it used to be free. So I need to update these slides. And Mattermark was free. They went kaput because they didn't make enough money. So these free models don't seem to be that permanent, I guess, now that I think about it. There are other paid alternatives to Sandhill Econometrics. There's a provider called Venture Economics. There's another one called Venture Expert. One of them is available through Thomson. So I think we might have access to it. The problem is it's access where you have to like get the data one by one yourself, which I'm not going to do that for 60,000 data points. So Sandhill Econometrics it is. There's a database called PitchBook and another one called CB Insights. These are kind of more modern upstarts. Out of the CB Insights is cheaper. PitchBook is more expensive, but everyone I've spoken to says PitchBook is much better in terms of quality than CB Insights. And from what I've seen, that's definitely true. It's useful with all of these databases to kind of think about pros and cons of different databases along the dimension of comprehensiveness, accuracy, paying attention to selection biases, right? Where data only gets put in the database if it looks good, right? And the bad data gets kept under wraps a little bit. It could happen. So we recognize no database is perfect. But despite this caveat, I view myself as a beggars cannot be choosers person in this situation. So I am just going to go and use that data anyway. But, we keep this caveat in mind. There is some research done by a University of Chicago professor that I've mentioned before, Steve Kaplan, where he's actually gone and done some research comparing some subset of these different databases to formulate his own opinion on what he thinks is better versus worse. So if you go to his professor webpage, you can dig up some of that research if you ever want to do due diligence on databases, okay? But I am using Sandhill Econometrics. Are we all right with this? I have a very simple punchline because I didn't do anything too sophisticated with this data. I just went and looked, well, what's the probability that an investment later on becomes an IPR and acquisition. And the database has seed stage investments, it has Series A, it has Series B. So I just did conditional averages. What's the conditional average that you eventually get an IPR and acquisition? If it's a seed stage investment, 31%. If it's a Series A, 51%. If it's a Series B, 58%. If it's a Series C, 70%. Those are the numbers from the Sandhill data. What about expected future dilution? Expected future dilution, I rounded to the nearest 5%. For a seed stage, expected future dilution is 70%. Series A, 55, Series B, 30, Series C, 15. Notice I've gotten these numbers broken down by round. The reason is I have the rule of thumb numbers broken down by round. And so I'm going to look at this formula, this reconciliation formula. I'm going to look at it round by round to get a round specific discount rate. Does that make sense? Let me show you what I mean. Let's do this for the Series A investment. Series A, the rule of thumb D was 60%. 5 years to exit. 5 years to exit. Series A, 51% probability of success, 55% dilution. So 1 minus dilution times probability of success. And then my 220 fee structure. Does everyone see that this is one equation, one unknown? So I just solved for that. You can do this in Excel using the solver add-in. You solve for this, you get an R equal to 14.6%. What does this 14.6% mean? It actually has a pretty neat interpretation. The interpretation of this, and I'm going to be rather precise, the interpretation of this is if the rule of thumb use of the VC method by VCs is correct, then it must be the case that the average discount rate to use to value a Series A investment is 14.6%. I can use this same equation for the seed stage. For the seed stage, it's 1 plus 0.8 to the power of 6 equals 1 plus R, where R is for the seed stage, to the power of 6, divided by 1 minus, I think it was 70% was expected dilution for seed, times 31% was the probability of success for a seed, and then 1 plus the 2%, but now for 6 years, over 1 minus the 20% carry times this mouthful of a statement, so I won't say it, but where the 5 is replaced by a 6. Again, one equation, one unknown. You solve it, you get 16.3%. Make sense? What this is saying is the average discount rate to use from time 0 until expected exit for a seed stage investment should be 16.3% if the VC method with the value of D equal to 0.8, if that is a legit thing to do. Do the same thing for Series B, you get 14.9%. Do the same thing for Series C, you get 13.1%. Now, look, I like to bucket Series A and Series B into one, right? So if you look at like the average of Series B and Series A, it's about 14.75%. And so you start to see a bit of a life cycle of discount rate here. Because for a seed stage, the discount rate from now to exit is about 16.3%. For a Series A, Series B, it's about 14.75%. And for Series C, it's fallen down to 13.1%. And then it falls down progressively a little bit more for Series D, Series E, so on and so forth. By the way, I don't show you data for Series E, Series D, and stuff like that, is because in my Sandhill data, there's much less data on later rounds than there is on earlier rounds, Because remember, the stretching out of the life cycle, the funding life cycle, is a relatively modern thing. Like you didn't see Series E in the 1980s. So most of the data in the data set is seed, Series A, Series B, Series C. So that's why I only focus on that in these slides. Are folks okay with this so far?
I just have two quick questions, if that's okay.
Yep.
So my first question is, I know you said it goes from like 1980 to 08 or something like that.
Yep.
Given your knowledge about looking at the industry over the last, call it 12 years.
I'm sorry, I need to correct my statement. The data is actually 1989 to 08. So I had remembered it slightly incorrectly.
Right. Okay. So given your knowledge of the industry and the space over the last like 12 years, do you think there's been significant changes that would cause these numbers to no longer be, as valid as they were, let's say in 08?
So here's what I'll say, because that is a good question. The numbers have changed for sure, because there's been a stretching out of the life cycle, the funding life cycle. So that's changed things, no doubt. And that means, if there's a stretching out of the life cycle, what do you think is going to happen to dilution?
Increase.
It's going to go up, right? So delta's gone up. So it might have been 55% before. Maybe it's 65% now, right? But despite that, I don't think it fundamentally changes the valuations. But this is an open question that one needs to look at with data, and I have not done that. So I'm just telling you a hunch, which is, yeah, what's happened is this has gone up, right? Which is going to make the valuation go down, holding all else equal, correct?
Yeah.
But when there's a stretching out of the funding life cycle, what do you think happens to the exit value?
Goes up.
Goes up. And I think those things probably close to offset each other.
Okay, so increased exit offset, increased dilution.
Yeah, and I have no basis to think. I have no basis for deciding which of the two effects dominates, right? Increased exit value versus increased value of D, so to speak, right? And so since I don't have a view, I just assume it kind of balances out. But that's an ad hoc leap of faith that I would love to correct with modernized data. But the reality is it'll take a good 10 years for me to even be able to like come close to claiming that there's enough data existing in the world, if you have access to it all, to be able to answer that question. It's too early to tell. But that is a caveat. That is a buyer beware aspect of using data right now.
Got it. Second question I had was, I just want to make sure I understand R correctly.
Yep.
That's the return to the LP net of all fees?
Yep.
Okay, so they're getting...
That's the required rate of return to the LP, exactly.
Net of fees, though.
This would be a net of fee return, exactly.
Okay, perfect.
Yeah. Now, there's a couple of... So first things first, let me give you guys a punchline here. Punchline is, for the purposes of this class, use the R's that I have here as the discount rate for valuing, from at time 0, stuff happening at exit date T. Use that as the discount rate. So the discount rate from time 0 to time 6 for a seed stage investment is 16.3% per year for this class, right? And for a Series A, Series B, you can go 14.6%, you can go 14.9%, you can go 14.75%, which is the midpoint of the two. But loosely speaking, go with about 14.75% as the average discount rate over 5 years for a Series A and over 4 years for a Series B, again, for the purposes of this class. I say for the purpose of this class, but I'd be comfortable using those numbers in the real world right now because I don't think I can do a better job. And same thing for Series C. Series C, anticipated exit 3 years from now. So discount rate over the next 3 years, 13.1% per year. I feel comfortable advocating that you do that, given the data that I've looked at. Now, there's a couple of things that could be criticisms to my statement right now. One, I'll start with the easier one. One is, this might feel really, 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 really weird to you, coming from someone who also teaches applied corporate finance, because what I have said here is what determines the level of your discount rate is what stage of the life cycle you are at as a startup. If you're earlier stage, you've got a higher discount rate. If you're later stage, you've got a lower discount rate. Look, I mean, that makes sense, right? Because we think of a startup becoming progressively less risky as it matures. So that doesn't seem debatable. That's not a weird statement. But there is something that's a weird statement here, which goes completely counter to what we do in other corporate finance classes, which is in other corporate finance classes, we tell you, like, go look at the details of the company. Go figure out the market beta of that company. Go figure out what industry it's in, because all of that is going to change your WACC, weighted average cost of capital, right? So we get really granular in the weeds with more mature companies, where we say, like, different industries should have different discount rates. And yet I'm not saying that here. Like, I'm not saying it because I literally wouldn't advocate coming up with an industry-specific number. And there's a reason for it. It's because I looked at the data broken down by industry, because Sandhill has a coarse industry classification. So they'll tell you which deals were healthcare, which deals were consumer internet. They've got a small set of industries that they classify in. I went and did this exercise, not just by round, but I also did it by round/industry. So where I did Series A for healthcare, Series A for consumer internet, Series A for other industry. And then I got that number for R in all the cases. And by the way, if you're comfortable with more advanced statistics, you can actually build a statistical test to test the hypothesis that that all of those discount rates are equal to each other. So Series A healthcare, Series A consumer internet, Series A hardware. I ran that statistical test and I could not reject the hypothesis that they were all equal to each other. Meaning, I don't have strong statistical evidence that this thing varies across industries once you control for stage of the life cycle. Which is, like, so different from what you see with mature companies. Like, to me, this was shocking. But look, I ran the numbers. That's what happened. And that explains actually why VCs use the same D for all industries. It actually starts to make sense what they do, which I think is pretty wild. Because to me, that was completely unanticipated up front. You guys see where I'm coming from? Here's the other thing that I'll point out is in traditional corporate finance, we tell you get a different R for different industries, but we never tell you about, life cycle of discount rates, because we tell you, oh, the discount rate is constant forever. That's why there's only one R in the NPV formula. You guys see what I'm saying? And notice here, we have an R that changes over the life of the company. So while we go less granular on industries, we go more granular on life cycle. And indeed, if you do the statistical test, hypothesis that the seed stage R is equal to the Series C R, if you do that statistical test, which you can also do, you reject the hypothesis that they're equal to each other. So that there's strong statistical evidence that the discount rate once you get to Series C is lower than the discount rate when it was a seed stage. By the way, if you're worried about Series A is lower than Series B, the difference between 14.6 and 14.9, it's statistically inconsequential. In other words, you don't reject the hypothesis that this is equal to this. Anyway, I don't expect you guys to be able to do those statistical tests, and I'm pretty much willing to bet all of my net worth that the VCs don't know how to do that test either, and it's not a criticism. It's just, I did it, and I'm just reporting the results. I'm not the only, I mean, I'm doing still pretty basic statistics. It was taught to me as an undergrad. So like, I'm not, patting myself on the shoulder or anything. Let's be clear about that. But it's just like, you either know how to do these are things called walled tests. So, if you've studied, more rigorous econometrics than what we usually teach at a business school, then you've probably seen like, the whole class of statistical tests, kind of falling under the rubric of a walled test, which ends up relating to something called an F statistic. Again, I'm sorry if I've talked over your head on this one. You really don't need to know that for the purposes of this class. Okay? And if you know it and it all makes sense, awesome. That's pretty good. You should be happy. Folks okay with this so far? Again, the punchline is pretty simple. Now, there's one more thing that I want to talk about to close the loop on this problem, which is, let's remember the fundamental assumption in this equation, right? This equation made an extremely, extremely fundamental and potentially controversial assumption. The assumption was the VC method is used correctly in practice. In other words, it's okay to use the VC method. It's legit. That's if the VC method is not legit, this equation does not hold. And as a result, solving this equation to get this number gives you not a very meaningful number. Folks okay with this so far? So I did something else because I wanted to find out, is there evidence that this number is actually reasonable? Because if this number is reasonable, then we can reverse the chain of logic. If this number is reasonable, then this equation holds, then the VC method is kosher. So I did that. Now, given the data that I have, I wasn't able to do it round by round. So I was only able to do this assessment for the average VC investment. So if you average all of these discount rates together, you get about 14.5%. Okay. So then I asked, well, is 14.5% a reasonable return overall on VC investments? Remember I said that Sandhill Econometrics develops an index of VC investments? I went and looked at that VC index and did an enrichment of what you normally do when you try to find out whether something has a good return or not, right? Which is you run a CAPM regression or a multi-factor model, right? Where your Y variable is that investment. So in my case, it would be the index. And I ran it on all the factors that I put into my model. This would be something you would see in investment management, for instance. And then I looked to see, well, when you fit the multi-factor model to the VC index, does the model give you a positive alpha, a negative alpha, or approximately a 0 alpha? If it gives you a 0 alpha, it's fair, or it seems fair. It's statistics, so you never know for sure. But it's suggestive that it's not bad. If it gives you a positive alpha, that actually suggests that you get 14.5%, but you should be getting less than that, so that VC is offering a pretty attractive return. So maybe I should try to put as much of my money into VC as possible. And if there's a negative alpha, it's the opposite. It's a bad deal. It doesn't offer as much of a risk-adjusted return as other opportunities in financial markets. So we should be taking our money out of VC. And so I ran the best, most tailored asset pricing model that I could come up with on this data. And what I found was, it's rather remarkable. My best model, literally, I did it for both Sandhill, and I found another index, which is by Cambridge Associates. So I got 13.1% with Sandhill. I got 15.9% with Cambridge Associates. You average that, you get 14.5%. I've never had anything look so close in my life until this moment. By the way, I'm skipping a lot of details here. Everything I have beyond this in my slides, CAPM, multi-factor model, talking about adjustments that I make where I really tried hard to tailor my model to the nuances of the data that I have. Look, I don't have the time to talk about it in the context of this class, and I don't think it's necessary to talk about it because it's not something that practitioners make use of. This is just the nerdy academic in me trying to make sense of it all, right? If anyone is interested in knowing the details on this, let me know. Let's save it for the end of the semester. But if you really want to know, I will give you a bonus session even during the holiday, not Christmas or Christmas Eve, but Boxing Day is fine. I don't give a shit about Boxing Day. And I will explain it to you just because if you want to know it, I mean, I respect your curiosity. And I'll walk you through everything I did and the logic behind it. But I basically, I did a super tailored version of an asset pricing model that I tried to tailor as much as I could to the nuances of all the data specifically around VC. And it just, I mean, I was floored with the result. And to me, what I take from that result is an actual comfort with using the VC method alongside the rule of thumb values for D and T. That's what I get out of that, which is like a super practical and useful observation that makes our life a lot easier. And that's what I'm going to be doing the rest of the course is I'll always be using the VC method, and I'm going to be putting all of my effort for the rest of the valuation of a company. I'll be putting all of my effort to trying to determine the exit value of a startup conditional on success. And I'll be building a few different ways for us to approach that problem. Because once we have this, given our VC method and rule of thumb values, doing this part is easy. Doing this part is easy. Doing this part is easy. The hard work is here. By the way, look, I know you guys have limited time, right? But like if you really want to understand valuation in VC and you really want to be able to defend the standard practices used by VCs, I recommend reviewing today's lecture and our last lecture at some point in the future and really dwelling on the observations that are made because they go to the core of trying to rationalize real world practices. So I don't expect that for the final exam. Let's be 100% clear. But I mean, if you want to be a thought leader in valuation in the real world around startups, this might be a good part of the competency around that. So, yeah, I'll leave it at that. I think this basically summarizes what I wanted to cover for topic 3, part 1, right? And as I said, topic 3, part 2, and part 3 will all be about getting this number. In part 2, we will get that number using comparables-based approaches. And I will cover, I think it's 4 different approaches to getting this number using comps. And every single approach I will apply using the example of Dropbox, where the example of Dropbox was something that I developed with the help of Dropbox's first CFO, who was my classmate in college and who helped me in building this course and introduced me to other people at Dropbox as well. That's why I know relatively more about the Dropbox story than a lot of other startups. It's actually completely luck. It's just happened. Sujay Jaswar and I were just classmates, and we respected each other. We're not besties, but healthy respect. And so he's been generous in helping me build this and systematize the discussion of comp space valuation for getting VT. So that's what we're going to do there. And then in part 3, we'll talk about DCF-based approaches to doing this. Look, and to be honest, in the DCF-based approach, I'm not going to be using a real-world example. So it's a little bit more academic, to be honest. It's mainly because I don't have an in a company where they went really far down that rabbit hole. So, people do DCF approaches. There's much less uniformity in how they do that. So I'm going to show you my way of reasoning around it. But if you're going to only really get comfortable in one, part 2 or part 3, definitely go with part 2, because that's the one that's definitely closest to being a standard practice in the real world. Meanwhile, part 3, look, I'm just going to be honest, at this stage of my life, it's still a little bit more Planet McGill than Planet Earth. It's the best I can do right now. Maybe later in my life, I'll be able to do a better job, but I'm just not there yet. Sound good? So that's what we're going to be doing the rest of this topic. And that's really what we're going to be doing over the next 2 weeks. So next week will be the comp space valuation stuff. And then the week after that is going to be the DCF-based valuation stuff. And then after we do that, we're on to the last topic of the course. Okay? So I hope this was helpful. And I hope you guys have a nice weekend. And I'll see you guys next week. Take care all.